Good afternoon, everyone. Can you hear me well? Well, hello, everyone. I'm Todd Schwartz. I'm the Dean of the A.B. Freeman School of Business, and it gives me great pleasure to welcome all of you to the 2024 R.W. Freeman Distinguished Lecture. Over the past 35 years, this lecture series has become one of the Freeman School's premier annual events, bringing nationally recognized business leaders to campus to discuss their industries, their companies, and their careers. The series is named in honor of Richard W. Freeman, a 1934 graduate of the business school and the former president of the Louisiana Coca-Cola Bottling Company and chairman of Delta Air Lines. In 1984, Mr. Freeman led the effort to endow Tulane's business school and name it in honor of his father, businessman and philanthropist A.B. Freeman. At this time, I'd like to recognize the members of the Freeman family in attendance today. Richard W. Freeman, Jr., West Freeman, Adair Freeman Parr, Louis Freeman, Jr., Tina and Philip Woolen. So let's recognize them. The topic of this year's Freeman Lecture is one that Richard W. Freeman would no doubt have found fascinating. How can we organize financial products and services to better meet the needs of the underserved population? In 2012, Todd Schwartz recognized a problem in the market. People who experience unexpected financial events such as medical emergency were often forced to seek out payday loans or even declare bankruptcy due to their inability to obtain credit, this despite their being fully employed and having steady income. Todd knew there had to be a better solution, and from that realization, he founded OppFi, a mission-driven fintech platform that helps people with subprime and lower credit scores gain access to credit with digital finance products. Since its launch in an office on the north side of Chicago, OppFi has grown into a $268 million public company that has enabled more than 1.3 million people to secure affordable loans. In addition to serving as CEO and executive chairman of OppFi, Todd is also a partner at Schwartz Capital Group, an entrepreneurial and dynamic family investment business based in Chicago, and a partner at Strand Equity Partners, a Los Angeles-based growth equity firm investing in the next generation of iconic consumer brands. Previously, Todd founded a multifamily real estate company that successfully purchased, renovated, stabilized, and sold $40 million of multifamily real estate between 2007 and 2014. So, students who are here today, I know many of you are interested in finance, real estate, and in creating your own companies. Isn't it amazing that Todd was successful in all three? At the end of today's talk, you have a chance to ask him any questions you might have. Todd is a 2003 graduate of our school, of the A.B. Freeman School of Business, with a bachelor's degree in finance. In a few minutes, you'll get to know Todd, and you will realize he's passionate about helping others. That is very clear in the reason he founded and created OppFi and its mission. His and his wife Gina's generosity has also touched the Freeman School, and we are also very grateful for that. Leading the conversation with Todd today will be Mike Yest, Associate Dean of Undergraduate Education, Senior Professor of Practice, and Peter F. Ricciuti Professor of Finance. Over the course of his career, Mike has developed several innovative experiential learning offerings, including the Freeman Reports program and the Aaron Selber courses in alternative investment. Mike is also co-director of Tulane's Ultimate program in international studies and business, And he has won numerous awards for his teaching, most recently the Albert LePage Faculty Award for Equity, Diversity, and Inclusion. So please join me in welcoming Todd Schwartz and Mike Yast.
Thank you, Dingo. Welcome, Todd.
Thank you.
We have all been waiting for you to come and excited for this day. I think that so many of us also will appreciate how you wanted today's talk to go. A nice sort of informal conversation. It allows me to finally pretend to be Oprah Winfrey or Barbara Walters. So I'll try not to make you cry as we talk about your successes. Fair?
Yeah, I thought that format would be better for the students and more engaging. So thank you.
Absolutely.
Thank you for hosting. I appreciate it.
It's good to have you here. So I do have a few questions, and at the end we'll open it up to maybe the last 15 minutes or so we can really get some good engagement with the audience. And I thought a good place to start would be the title of today's talk, right? I mean, from pawn shop to public company, it feels like there's a really good story in there that you can share.
Admittedly, when they asked me what title we wanted to use for this, I wanted to get people to come out, right? I wanted it to be a catchy title, but no, there really is some truth behind the title of the talk today. Back in 2012, a lot of you weren't around or in the working world for the financial crisis of 2008, but we were starting to unthaw and things were starting, and I was reconnecting with old friends, and one of my friends from high school was working at a pawn shop in downtown Chicago. He said, "Yeah, I'm working for two brothers. It's a really interesting business model. We should have lunch, and then I'll take you by the pawn shop. And you can see kind of what goes on there." And I had never been in a pawn shop before or really understood kind of the business model or what they were used for. So after lunch, we went to a pawn shop in downtown Chicago, and I observed a woman walk in nursing scrubs from Rush Hospital. And I saw her pawning a wedding ring or something of significant value, or an heirloom, if you will, for cash, to meet a financial obligation. And I thought to myself, it was a profound experience, but I thought to myself, why would she do that? Why is she in a situation where she needs to use a very valuable asset to her personally to fund the financial obligation? And the way I work, and as you get to know me, I'm a very curious person, and when I start to think about things, I go down like a rabbit hole, and I start to become immersed in it. And to my amazement, what I discovered was there is about 15 to 18% of the US population, which is roughly 45 to 60 million people, that fall below the 650 FICO score. And for all of the young people out here, FICO score is something that is really a measure of that financial institutions use to determine your credit worthiness. The higher, the better. So 800 being amazing, below 650, not as credit worthy. And it could not be credit worthy for a couple of reasons. You had when you were young, you took out some credit cards, you didn't pay some accounts, and a large swath of the US population falls into that category. And I thought, okay, how are these people getting access to credit for unexpected expenses, for unexpected bills, medical, school, auto? And they were being serviced with pawn shops, with title loans, which you sign the title of your car over and potentially get it taken away if you don't pay, really awful. And payday loans, which were these single payment, super, super high interest rate products that were not really they didn't really underwrite the customer, build lifetime value, or really think about the service level, right, and engaging the customers and the retention of the customers. And I thought there's got to be a better way. And that really is the founding story of how I came up with the idea. And the name OppFi is actually Opportunity Financial. It was an opportunity to get a chance, right, to earn a better opportunity to get credit access. And that's kind of how it came about.
That's amazing. And such intentional and purposeful work, right? How does it look on the customer's side? I mean, I get the concept, but so is it one product that you're able to give them, such as a introductory credit card, or is it a small loan, or is it a menu of options that you're able to give?
Yeah, I mean, one of the, and take a little step back, one of the questions I always get asked is, why don't the banks offer this? The banks have the cheapest cost of capital, they're the largest distribution. And, you know, at the time, I did some research. The banks were servicing these customers with NSF and overdraft fees. And these are fee-based products that customers, when they go over, you know, below zero, or they take out, you know, they pay for something and they don't have the credit behind it, they can get charged fees, and it was $31 billion a year in 2012 that banks. So they were servicing these customers just with fee-based products where there was no transparent APR, there was no customer retention, and that's how. So most of the customers I discovered have bank accounts with Chase, Wells Fargo, all the big name banks that you'd expect, Bank of America, and so forth. And so back to your question, what I designed the product, it was very, very important that this was easy to use, easy to understand, easy to administer from a standpoint of the company operationally, but also for the customer. So from a credit education standpoint, transparency standpoint, and the stating of the true cost of the product. So when we designed the product originally, no origination fee, no late fees, no prepayment penalties. It was simple daily interest, fully amortizing, which means when you take out the product, it's paid back in affordable installments, and then you're done. There's no billing in arrears or minimum payments, which is a lot of the troubles of the credit card industry and why people get into credit card debt, is you pay for things and then you pay for it later, as we all know. And that's why when my children are young, but when they do come to college, they'll be getting debit cards, not credit cards, to keep them out of trouble. When it hits zero, it's zero. Right. And that's good. But this was really in the product design, and then also on the underwriting, right? We wanted to retain customers. We wanted customers to be happy, but we designed things like a turn-up program. So a lot of times customers come to OppFi and they don't know that they qualify for lower cost of capital with a preferred partner of ours. And so we even offer that, which is kind of counterintuitive. A lot of businesses, it's so coveted to get a customer, but you know, it's our brand promise to our customers. And so this was all gone, this thought was really all gone in and developed into our mission statement of really giving high quality credit access options to the 60 million people that lack traditional access and traditional options.
Wow, it's almost too big to think of. I can only imagine when you started this, you didn't really have a benchmark, if you will, right? I mean, there was no comparable. You just kind of went into this field. Can you give us a sense of what that was like to kind of just like, you knew what you wanted, you knew it was a good thing, but how'd you go from A and then to B and then to C?
That's a good question. So I didn't have lending experience. My father had a very successful call center business or outsourced customer service business that he ran for a long time. So I kind of grew up in it, but we didn't really have specific lending experience, but we had some customer experience, right? And I think you know what everyone told me. A lot of people told me, Todd, you need to go build the technology, and you're never going to make the economics work because the losses will be too high, right? Mm-hmm. And when someone tells me it, and you know, my dad and I, like, it's a challenge. I take that as a challenge. I said, oh yeah, I think we're going to figure this out. We're going to build this on lifetime value. Nobody was doing that. Everyone was, we need to make as much money and fee people. We need to charge as much as we can, or have an asset behind it that we can take if they're not able to be successful. And I challenged that. And a lot of people said, go raise a bunch of equity. A lot of people told me to go, you know, build, and to your point, it was such a large scale problem that wasn't going away. And it was really, I had to just get the service and product delivery correct first, the unit at a unit basis. And I had to meet people. So I opened a one-room office on the north side of Chicago with a phone and a computer, and really went at it. I got a small dollar lending license from Illinois. And I started getting referrals from the same pawn shop where I had that clandestine experience and saw the woman where they didn't have necessarily something to pawn, and they referred them to me. And so But that's where I started, and I went very slow, and I did the first 3,000 loans myself. Actually meeting every single customer and learning why they were coming to OppFi, why we were better. And the process was one that I would never give back, and one that really is the soul of our business today. It's really what defined the business and the soul of our business today is those early days of me meeting customers and really getting to know them.
Sure. And those customers, like how many of them are you helping them to stop a perpetual cycle of using the payday loans and, continually each paycheck less and less they can take home? How many of those customers you sort of stop the bleeding and then helping them with credit-wise versus sort of a new credit first-time engagement?
Yeah, I mean, there was a lot of people doing what they call payday loan stacking, right? So they take out one loan to pay off another, and kind of building up these these products are small dollar, and so they weren't solving a lot of the issue. They needed more like $2,000, $3,000 products where they could pay back in affordable installments, and they were giving them single pay small dollar products. And so we saw that early on, and a lot of it was educating our customers, like this is an installment based product, right? The amortization. So a big part of our offering was credit education. We used to have early on something where customers would, if they did credit education, they would get discounts. Like they were willing to learn about personal savings, about credit score, about borrowing and responsibly, right? And being responsible. And I think that trust and that transparency, garnered, we started to track our NPS, and to our amazement, it was up at the level of Apple. Like I think Apple, is in the 80s, and we were at about 81, and still today at this scale are at 79.5. So, have been able to maintain that. And what that means is we took the time to listen to the customer, to build the right product that drove real value to the customer, as opposed to just doing what made money or doing what we thought, right? We built it the right way, and that was something I'm really proud of. I track, now I'm back as CEO, one of the big metrics I look at is customer satisfaction and NPS on a weekly basis, and if it dips, it's a timeout. Hey, let's stop the ship. We need to go to figure out why. I want to read these complaints. I actually read what customers say to this day to get insights and information, because it's so important to me that we're delivering the value and actually doing right by our customers.
And those outside the space, NPS means? Net
Promoter Score. So what it is it's a survey essentially for customers at different life cycle points in the journey of a customer. So at origination, at first payment, at we even collect it if someone is having payment issues in past due status. So just to make sure all along the life cycle journey of the customer, paid in full customers, and so we market at all those and get those data points to make sure.
Interesting. So, and somewhere it sounded like you were saying that this is part education as much as providing a service.
It is. Now, we since we're the leader, most companies have gone away from payday and gone and tried to emulate or copy kind of what we're doing with the installment product and some of our product features, right? But at the beginning, this was a new concept. The installment loan's not new. It's similar to a car loan or a mortgage in that it's an amortizing product term loan. However, there was a lot of education that was needed and explaining why this is better, and that customers can pay this in full and it's paid in installments. And so, but as the market developed and as it started to expand and we started to get some competition, I think it became much more normal for customers, and they expected it today. And really, when we set out, we said we were going to eradicate the payday loan, and pretty much, I mean, it's still being done. I'm not going to say it's not being done,
right,
but it's much less prevalent than when I started in 2012.
That's great.
Yeah.
It's a great legacy to have. As you sort of, so we'll go back to the beginning. You're making the loans yourself, right? One small office that you're working out of. No real benchmarks. People are saying this is not going to work. How did you then, in your mind, sort of set your own benchmarks? How did you define success? What were your milestones? Was there a point? We'll get into later, but like in the beginning, what were those sort of incremental, I'm doing something right, we're making progress?
Yeah, I mean, well, number one, I was using a lot of my own capital, so that's always good. And I also had really patient investors, my family members, or immediate family members. But no, I think you don't have the data, you're not going to have the analytics to know what you're doing is right. A lot of it is by feeling, like you feel like you're doing the right thing, and you're creating a better product. So a lot of it is just this internal motivation and drive that you have to believe if you keep doing this over and over and again, it's going to get better, you're going to continuously improve it, and it's going to eventually be something great. I remember the first month, I sat in this office, and I think we did 4 loans total. Like, if you can imagine sitting there for like 10 hours a day and getting 4 phone calls. And then on top of that, when their first payments were due, none of them paid because there was a problem with the payroll taking the payment. And I just think, like, at that point, there was many points along the way where I should have probably said, like, let's wrap this up, let's go back to doing real estate, or go back to, go get a job somewhere else and work in another industry. But it was really a belief that, like, we're going to change outcomes for a lot of people, and I'm going to leave a legacy of changing the way people access credit in America. And that bigger belief and that mission statement has literally not changed. If you look at our mission statement today, it's the exact same as it was in 12. And, really getting like-minded people who were passionate about providing that credit access or better options for people, and believing the solution was going to come from the private sector. And that's really, where the belief in that is what kept me going.
During those times, again, one more question that harps on the hard times. Then we'll get to the more fun part. But I think a lot of our students here are entrepreneurially minded. We have a great entrepreneurship minor, and with that, we also know that most startups don't make it, right? So you call the J curve, right? This idea that there's this period in which you're hitting financial troubles, you're bleeding red ink, and then at some point, sure, okay. So for the successful firms, they get to see the whole J curve, right? Most firms, Howard Love, famous angel investor, calls it the valley of death. Can you get out of the valley of death and then be able to? So I guess, how long was your valley of death? Were you, clearly you got out of it. Was it months? Was it years? And was there a point in there that you said, this is it? Like,
Yeah, I mean, if at first you're doing so few of your product and so little that you really have to kind of go off about what customers are saying, right? Like, the data is not going to really tell you if you're going to have the growth or the viability of the product. I knew there was a big addressable market out there, right? And I knew there was inferior products being used, right? So I had that data. I also knew my customers were delighted. They loved us. They would refer their friends, family members, colleagues. So I had those data points, but I didn't have the financial proof yet. But I spent all my time on developing the product for the customer and the service delivery, and knew, and this will give you comfort, is that you have an addressable market, there's demand, and you have a good unit economic model. So at a unit basis, if you strip out some of the extra costs you're using to grow and all the overhead and stuff like that, you knew that it was a positive unit P&L and that we were generating profitability. And I knew if I kept doing it, and then you kept scaling over time, and in the confines of the unit economic model, that it was going to be successful. Sure. So that gave me some comfort. Obviously there's a lot of distractions and things going on but if you have that comfort, then you're going to keep investing, right? Especially investing your own dollars and your own equity to know that it's going to work and feel confident. I think one of the biggest pitfalls or issues is people are quick to deploy equity into things that maybe are not needed early on because of things like I was told, like go build all this big technology, when the reality is I did see some others in fintech do that. The rate of change in technology is so quick these days that it becomes obsolete in 2-3 years, and then you're having to go back to the well to reinvest that equity into new technologies. And I think we built it over time. We were really pragmatic and practical about it, and and thought about what are our actual needs as opposed to what's nice to have, and really focused on the right things and got the right things right, I like to call it. And that was big. And then also taking money. So I never raised outside equity. Still to this day, it was only internal money from the family. We were very capital efficient. I fought for every dollar. But also I went slow enough so I could course correct, and I didn't make the big mistake. I think that's a big thing. But I see a lot of companies taking on either too much equity or taking on equity, and unfortunately, you essentially then have a boss, right? Like your boss is the preferred equity, and they're going to have, even if it's growth equity, it's going to have a lot of negative rights. You're going to have a lot of limitations and restrictions, and you got to be very careful when you're taking on equity partners of who you're bringing on and what their goals are. A lot of the time should be spent, obviously, in negotiating the structure, the terms, is really alignment of how you see the vision of growth, and only you will know the right time to turn on the jets and start to grow and scale. And if you get the wrong partner, they could have you do that at the wrong time or the wrong macro environment, and it could really take a great business idea with a great leader and make it not successful. So you have to be really careful when you're selecting your equity partners, and if you don't need the equity, don't take it, right? You can control your own destiny that way.
Sure. Let's focus more on the success, right? This amazing company that you have built from scratch, and stories like the woman in scrubs and the ring that maybe your company could have stopped her from having to pawn. Do you have any other moments in which you've sort of been stopped in your tracks to realize the benefit that brag on yourself. This is, have there been moments which you're like, this validates why we're here?
Yeah, there's a couple moments along the way that have, I've gotten that validation and that feeling. I think like to this day, if you go to our office in Chicago, we have TV screens up on the office, and they're customer testimonials that flash across the screens that I'll stop and read them, and just honestly, like at the end of the day, like that's the truth serum. That we're still delivering value to those customers, and that I'm doing the right thing. Like some of these testimonials are just absolutely moving and inspirational, and a lot of them have this sentiment of when no one else gave me a shot, and you were there for me, and you gave me an opportunity. It stabilized my financial situation, and I've come out better because of it, and that's why we're there. But to answer your question, I think we were this small storefront lender that was doing direct, through state licensing. And what happened actually, and this is when you, on your journey, while you go slow, things start to happen, and you can take advantage of them if you're going at a really good pace. What happened was there was a massive consolidation of banks after 2008. Right, there was a lot of money that came in from the federal government to rescue a lot of these banks, but it came with strings, and a lot of the strings was, hey, you got to get bought or you got to consolidate. And so with less banks means less options, and there was a lot of community and smaller banks that were around that didn't have the branch network of Chase, Wells, and a lot of these bigger banks that have branches what seems to be on every single corner. And I started talking to these banks at one of the major conferences, Lend It, that happens every year in New York, and they started to say, hey, I like what you're doing, and we really have alignment on expanding credit access. Like, we really think what you're doing is unique. We love your mission. We love the branding of the product, and we love how you service it. It's so unique, and your customer satisfaction. We could get behind something like this where we could go more national with this, right? And essentially, we would then, instead of becoming the lender, become a vertically integrated servicer that helps with acquisition, the technology, the underwriting, the infrastructure, and all the way through, to payoff and retention. And we got our first bank to get it, interested. We signed the term sheet, and I knew that this was kind of the future state of opportunity of OppFi, is that we were going to be a vertically integrated servicer to banks to allow for our branded product, co-branded product now, called OppLoans. And so that really is the direction that we saw and took, and has been, really, really successful, and it really helped us get more scale and more distribution, and then really allowed us to invest in technology to automate a lot of the processes behind the scenes to allow for growth. And today that is our model. We went from a direct line. So we pivoted, right? It was a big pivot. There was a little bit of risk in that, but I saw that we didn't design this business to help a small subset of people in a small geography. To really make an impact and serve over millions of customers like we're doing today, it needed a slight model change, and we needed to get the banks to buy in. And these banks wanted to compete on an unsecured credit, and they were not able to, and they needed that technology and infrastructure that we provided. So it's been a great partnership between us and the banks.
I'm so glad you bring that up. In one of my finance classes, we talk about companies that fail because they grew too quickly, right? And it seems to be a concept sometimes. What do you mean? You had too much growth is always good, right? But if you haven't laid the track, right, you can be the first one that your customers are upset, right? You didn't realize that state A works different than state B, and you just expanded too quickly. So it sounds like you're very purposeful as you've expanded.
Yeah, test and learn, right?
Right.
Always testing and learning, even if something seems so obvious that it's a no-brainer. I think you never want to do 100%. You want to always test and learn into things. And if it's a good idea and it's merited, I think it'll be there, right? It'll be there when you test and learn and are 100% confident to deploy it. But yeah, allocation, return on investment, allocation of capital, those are all very important concepts, especially in early stage businesses when equity is very valuable.
Sure.
And making sure you're doing the right thing.
Sure. Well, let's take you back now to Tulane, all right? So here you are, we're thrilled to have you back. Sort of, when you think about it, you're only 20 plus years out from, and that might sound like a lot to you, but it doesn't to me. So, and when you think about it, and you're seeing the building that's changed quite a bit. So there's some things that have changed, sort of physically in the space. Take us back to the early 2000s when you graduate. What was the impact of Freeman, Tulane, and even New Orleans upon the person you became post-graduation?
Yeah, I mean, first of all, growing up in the suburbs of Chicago, going to Tulane was a big jump for me. Like coming down to New Orleans, I had never really spent time in the South, and it was so unique, right? New Orleans, you get the backdrop of New Orleans, the music, the culture, the food, the people. Being in the South, like it was an exciting opportunity for me. I was happy that they let me in. Today, just to be clear, today I don't think my grades would have made the cut. So it's definitely gotten harder to get in, and the school is flourishing. I mean, credit to Scott Cowan after Katrina building the school back, and now Mike Fitz doing an incredible job. And Paul, thank you for that warm introduction, by the way. But the business school is flourishing as well, and I think I always say this about Tulane, and this is what I love about the school. It's a real balance of academic and social. It's a really unique place where you get to combine both, and both are very important in life and in business, right? If that's the path you're going to take, it's a combination of the two. And I noticed that the kids that I met with a bunch of undergraduate students, I met with MBA students today, very well-rounded, right? We're developing very well-rounded, future adults that are gonna do great things, and I wanted to be a part of that and partner with Pao and the whole, and Mike and the school, and thought that the Schwartz Center for Experiential Business Learning was the right next step, right, to combine with all the great things that are being done here now, and to kind of be a program that can collaborate, but also be a program and a tool for students that are here now, but also for the future.
Yeah, that's a perfect pivot into, if we just walk down the hall, we are in the process of, we've done the demo, and now we're doing the build of this amazing, generous gift that your family has made to help support our experiential learning. I'm sure that you have many people coming to you and saying, I've got a great idea, invest in us or support us. I mean, what was it that made you connect with this endeavor here in the Freeman School?
Yeah, I mean, I have a big place in my heart for New Orleans. It was instrumental in my development as a person. I mean, I just everything from touring the South, the friendships I've made here, the lasting impact it's had on me. I only spent 4.5 years here, but it's something that it was some of the greatest years of my life, and something that I'll always cherish. And I wanted to give back. I wanted to be a part of it. I come here, and the youth and the energy, it really inspires me, and I love being available, being able to help in any capacity, and so it was something I really wanted to do and really spend my time on, and that's the truth, right? And the great team here it's been really fun to work with. What a team, and they make it easy for me because it's so seamless. And putting together events like this, but also I'm excited for the opening in September, and hopefully all of you will be able to make it for the dedication.
Absolutely, absolutely. And how did you learn when you were here? So this term experiential learning, right? It's sort of, it's not a buzzword. It's a methodology. It's an approach to learning. Did you find yourself gravitating towards that sort of style more often than just reading out of a textbook?
Yeah, when I to give the best example, I was somewhere in the middle of the pack academically in school, right? I wasn't the worst, but I also wasn't the best. And you kind of know who the kids who are academically performing at a really high level. And when we went on a field trip, I discovered this about myself. We went to a family bakery, and I got to participate in, helping make the dough, got to put some stuff in the oven. I got to learn about their business model. We went to Chicago Tribune, the local paper in Chicago, where I was able to see the printing presses and understand how the writers delivered the stories. And when we went back, the weekend hit, and then we went back and we had a quiz, and we also had a question session, and I was the one raising my hand and answering everything. I almost had like a photographic memory of what occurred a week ago, and the kids, who were traditionally like the ones always raising their hand and getting all the answers right, weren't answering and weren't engaged. And I said, whoa, like maybe the way I learn, or maybe the way I process things is just a little bit different, which is okay. And I've always known this about myself, that learning by doing is the best example I can give. And I think you do need, I'm not going to say that the traditional and academics are not important, they're very important, but combined with this learning style, it really just can propel you into, for somebody who's not a traditional learner, into it can unlock a lot of potential, and it can really, set them on a really great trajectory for life and career.
Yeah, I couldn't agree more. The idea of this foundation, that yes, the foundation, you'll be in a more traditional setting, if you will. And then when you get to these upper level courses, you can really, just open your mind as you connect to, trying to get as close to, I use the term real world, but as close to the career or the job or the task or the skill that you need to have when you get out. And that's what your gift is going to allow us to do. I mean, we have a history of many experiential learning programs, but to have a center that's going to be the heartbeat of it is something that is really, it's an amazing gift that you're
yeah, we were kind of brainstorming before this in a meeting with our team, as the center approaches, about some of the ideas and some of the things that we can focus on, but even little things, right? Like real world, like how, like I get so few emails now because I use Slack. Slack is a business tool. I think Microsoft owns it now, or Salesforce, or one of the big tech conglomerates. But it's such an effective, efficient tool. But like Slack etiquette, how to use Slack appropriately, how to be efficient, like little things like that, where we can give real world examples and real tools to better prepare students for when they come out, or how to give a PowerPoint presentation, right? Like the proper way, like the real way that we want to see it, that's efficient, hard hitting, and will get noticed and impactful. Little things like that, that's just real basic examples, but connecting them with employers and getting them assignments in the field so they're actually working and seeing how great companies operate, right? Like setting by example. But all these are great ideas that are being floated around for the experiential business center, and I'm excited. I think it's going to be a lot of potential, and then the collaboration opportunities, like I said before, are endless.
Yeah, we have this a series now of Fridays at Freeman in which these sort of, pointed and targeted skill sets, right, that can be tied to the experience, what you need to be able to get out there and be competitive, it collaborates very nicely with this center.
Yeah.
So let me, we're going to probably open up Q&A in just a little bit, but before we get there, I'm curious, a lot of seniors might be in the audience, and I see fear in their eyes sometimes when they enter into their senior year. And I often get the feeling that they still are living in the world of that there is a linear trajectory in which your first step outside of Tulane is going to then lead you to, it must be the right first job, or else you are not going to have a successful career. And so, not to lead you where I want you to answer, but I think in talking to you now for quite a while that I understand your path has involved zigs and zags. And do you think that is the expectation that students should now have, that a career is in your 20s, 30s, 40s, and beyond, it's not going to be linear?
It's not, and I think the world's changed. I think, with technology, with connectivity, the world's changed. Opportunities are much more abundant, and I think you're going to hear about the path, right? Like, I'm in private equity. I know, 2 years of investment banking, go back to MBA, then private equity. There's paths, and you're going to hear about path a lot. I would just say stick to what feels right for you. I mean, that path's not, it's worked, and I've seen it work for people, but it's also not the only way to get there, right? And you got to stay true to yourself and make sure that you're comfortable with the direction going. And I just love what you're doing. Don't be miserable, because it shows. When someone's miserable at what they're doing every day, you just know, have passion. Actually, try to mix both so that you're going to spend a lot of time at work. So make sure you love what you're doing. It's not always possible. I know, I understand that, but find something that you're passionate about so that it doesn't seem like such a chore or a job every single day. But yeah, I think a lot of that fear of the seniors is that they're going to have to start getting up a lot earlier in the mornings.
Consistently.
I remember those days. The transition from waking up at 10 o'clock and going to class at 11 are over. So yeah, but you get used to it. Don't worry, you get used to it over time.
Fair enough. Do we have a microphone set up so that we can pivot to some Q&A? Is there anyone who would like to ask some questions? And where is the microphone coming from? Can you yell? All right, let's start out.
Hi, I'm Claudia. I'm a senior. I was going to ask, so we do a lot of pitches in our, kind of to help. Oh, we do a lot. Oh, can you hear me? Okay. Closer. Oh, got it. Okay. Hi, I'm Claudia. So I was just wondering, so you said that a lot of, you originally were talking to investors that were family members and whatnot, and a lot of your data was coming from customer lifetime value. I mean, what happens if you went into maybe you were pitching to some other investors that were not nice like your family members? What advice do you have to entrepreneurs like us that are pitching to investors when maybe you have only data like a market that you see or customer lifetime value? What advice do you have for us?
Yeah, I think you have to be careful, because venture capitalists, their terms are pretty onerous, and they know what they're doing, and you got to be real careful. It's a relationship thing. I think you got to spend the time to find the right. I'm not going to say that people don't need venture capital. It's needed, but I think if you can do a deal with the family, friends, angel, all those are better options, because they're just going to be more flexible and allow you to build the business you want to build. I think ultimately that's my advice is don't change what you want to do and what you know is right because of a capital partner that frankly is looking at probably 10 other industries and deals. And the typical venture model is they make 100 bets and hope that 10% of them work out and are huge home runs, right? So they're not necessarily as informed as you are. They're not on the ground. And have confidence, that you know what you're doing, and don't stray from that, or be forced to stray from that from your capital partner. They shouldn't make you do that. It should be additive. And watch the terms too. Make sure you have an advisor that's, knows the space. Because, valuation is just one metric, I'll tell you that. So people think, oh, I'm getting such a high valuation. And if you pay, there's other ways, they can do participating preferreds on equity. There's structures that they can do. These people do this, every day. So just be careful, what you're signing up for, and make sure it's usable capital and that it's going to help the business in the right way. Yeah.
Who else? Back here.
Hi. So early on you talked about how retention rate for your customers was really important. But like, for example, if you were loaning out money to a customer that was behind on credit card debt, and then they'd use your loan to get back on top of things and their FICO score came up, why would they continue coming to you, who represents more people with low FICO scores?
Yeah, I mean, they wouldn't. And to be clear, we have no prepayment on our product or no origination fees. So we are comfortable, we lose money on those sets of customers. If they pay off in 3 days, it's 3 days of simple interest. I think what happens is they'll come back to us because they were happy, they had a good experience, they didn't feel taken advantage of, and they'll come back, and if they qualify for lower capital, great. That means we did our job as in our segment. We help them, get to lower cost of capital. If not, we're there to service them with a product quickly and efficiently, and that's kind of how we think about it. For our customers is we want to make the experience so that they'll happily come back if they need us, if their situation or circumstances haven't changed.
So based on that, do you have a high retention rate of customers coming back? And if you do, is that not kind of a sign that they're not properly utilizing this loan you're giving them?
Yeah, I mean, we are, the truth is it's tricky. We do report all payments to credit bureaus, and we do try to give people credit education tools to help them improve. But the reality is we don't control all the variables of their financial life. Like the income that's being generated is a big variable. Other obligations that they may have, right? So we help. And we're doing what we can and solving an issue in their financial lives, but we're not the only variable. And so I think that's kind of we do everything we can, right, in our power. It does take willingness from the borrower and the customer to also want to get better and improve. They have to be willing and able as well.
Sure. I saw a question here, and then there's one in the back too. Okay.
Hi. What prompted your decision to go public?
So it was a long thought process that went into it, and I think ultimately the decision to go public was, number one, is obviously the valuation and the structure. It allowed us to. It legitimized what we were doing, right? And it rewarded the management team that had been with us for 5-6 years at that point with the value creation, and it allowed for us to ring the bell on the NYSE, but more so than that, we have a vision, and we still have a vision today, of OppFi being the platform that services digital financial service products, and not just consumer. Looking at small business, looking at the purchases of goods and services as well, and other products. But being a platform and having that, we wanted to challenge the business and be front and center when it came to investors and regulators. And we thought we would make the business better, but we were able to retain control. I got some liquidity, but still we're able to operate the business substantially the same. There are challenges, right? There's alternative being public. You got to do a lot of other things. There's SOX, there's SEC, there's quarterly earnings reports that are, so you have to think about all that. But ultimately, we tried to keep the business substantially the same, even though, on the other side of being public. And part of the reason I came back in was I wanted to continue the legacy of OppFi and continue to build what I thought was possible, right? Being the leading digital alternative financial service provider in like a platform business in the space where we saw supply-demand imbalances and where banks don't cover it. So something we're looking at real closely right now is small business lending. It's very similar dynamic to consumer, where the banks, if you need $250,000 or less in small business, it's without a severe personal guarantee in 6 months time frame, it's very hard to get a bank loan, right? And they're not designed or incentivized to service Main Street America and small business. And so we think that, we're looking at opportunities there. And then also you guys have heard about buy now, pay later and some of the financing options. We are looking at, some of those different models in the space and, maybe how we can enter with our brand. So, I think that was some of the thought that went behind, going public.
There's a question in the front.
What is the best way that you've acquired customers, like specifically from the beginning when you maybe didn't have as much of a strong reputation? Like, how did you convince people to use your product if they didn't know like what your reputation was? And then my other question is, do you currently focus more on customer retention or customer acquisition?
So to answer your first question, referral. Like in a service-based business, referral is going to get you strongest customers at the lowest cost, right? It's something that we actually pride ourselves on today. Have a very robust referral program, and we've actually developed technology to be able to fulfill, pay those referrals out. It's very unique to us in our and how we acquire customers. So I'm a big believer in referrals and word of mouth. It's kind of old school, but obviously we've evolved our funnel to much more larger scalable things as well. But that's my answer for that question. And then your second question was about retention or acquisition. They're both important, right? Whether retention means that the customer, when they're paid in full, is happy and would use, like one of our questions in our CSAT is, would you use OppFi again, right? And they're both very important. But in lending specifically, when you have a customer, to that gentleman's point, you got to be a little careful, because when they paid in full, that's a great behavior, and you don't want to necessarily give them credit if they don't need it, right? But you want to also be there, so it's a little bit of a dance, right, in the space. But I think, when those customers, you don't have acquisition cost, and that they're a known entity, so the credit is usually very strong. So they're both, in an acquisition, you need to grow the business, right? So they're both very important and something that you really need to focus on both if you're doing things right.
Over here, and there's been a hand in the back for a while too, so we'll start with Matteo here.
I'm interested in serving underserved and low-income communities. So how did you overcome that bias that sometimes investors have, or even general markets have, with firms that general clients are low-income and underserved communities?
So I thought the same thing. And I remember talking to my dad, and I had breakfast, and I told him about the idea, and he's like, no, you're going to take advantage. It's going to be not good, reputationally. Like we don't want to do it. And I said, Dad, like you don't understand. Like what I'm seeing is like these are gainfully employed professionals that have families, that are stable people that, if you look at the cost of healthcare, cars, food, auto, it's inflated at rates well beyond where their wages have grown. And what happens is they're fine and they're stable, but then an unexpected expense comes up. Their car goes out and it's not under warranty. They have a healthcare deductible that they have to pay. They have back to school for their children, books, whatever they're not priced for. They get hurt, miss work, whatever the reason is. But to my amazement, like that's why I decided to meet the first 3,000 borrowers. Like these are really good people that know what they're signing up for. It's not taking advantage. Like I didn't, if I felt that way, I would have stopped like early on. And like I said, the word of mouth, that like the feedback I was getting and the referrals I was getting really was the proof to me that, you know, these customers, they know what they know what they're signing up for, and that, you know, if you treat them right and fairly, I think you can check. But one of the things I spent a lot of time on is with policymakers, regulators, is explaining the problem of credit access. Like, it's not something that people just inherently know, right? There's topics like affordable housing and things that are talked about much more, you know, broadly, and people are much more informed about. But like the reality is, I mean, and I can say this in a business school, is, you know, the only way to bring costs down is more supply. Like Milton Friedman, I think, well documented that, right, in economics, that you need more supply. There's other tools that, you know, government and policymakers can use, but you have to always combine that with more supply to bring costs down, and competition is gonna help that.
As we start to wind down, I do want to get that one question. I keep seeing a hand in the back. Can we get a microphone back there? There we go. We'll do two questions.
Okay.
No problem.
So maybe not the best piggyback off of that question, but I guess since like low credit people are low credit for a reason, you know, they don't pay their payments on time. So what's kind of your guarantee? How can you get your money back? Like if that makes any sense?
Yeah, I mean, so that was what we did differently. So we spent the time to actually look at people's, you know, bank statements. We look at their paycheck and verify their income and make sure they can afford to pay us back. And by in turn, that helps, you know, obviously delinquency. I think, you know, people make mistakes in life, right? They take out more credit than they can afford. They maybe made a purchase that they couldn't pay back. They did. A lot of people got affected by 2008. They took out mortgages, and then when their house was underwater, the bank took, you know, the house back and destroyed their credit scores. There's a lot of reasons, right, of why they got hurt and missed work and weren't able to pay their bills and had to file bankruptcy. You know, so you can't kind of one size fits all. And I think what we do is we say, okay, we realize that you've had something in the past that's either you have no credit or you've had something went wrong. Let's look at your current situation, though, your current income, and can you afford this, and are you willing and able to pay this back? And that's really what we went up, and then we were able to digitize that with technologies to make like a scoring model on it. But I think that was, you know, really where we said we're going to investigate this and actually look through the FICO score and actually underwrite a borrower the traditional way and make sure that this. But no, our loans are unsecured. So, you know, obviously, we only make originations or loans, if you will, to customers where we truly believe that they're going to pay us back, because it is unsecured. We do report to the bureau, so it would show a negative trade line, but that's really our only security. And obviously, we're not like an aggressive collector of credit. We're very values-based. And, you know, we do a lot of debt, like restructuring of people's, you know, product to make sure that they can pay us back. We're very friendly on those types of situations or hardship. We do a lot of hardship. Like, I know that when Hurricane Ida happened, we did a lot of hardship programs for borrowers to make sure that they could, you know, pay us back or stop paying us for a while and stop interest accruals for people. So we're always doing the right thing to try to, you know, make things if people are not able to pay.
That's great. Let's close with our last question, and then I believe Dean Goes will come back up for some closing comments.
Yeah, so you mentioned that you graduated from Tulane in 2003. However, OppFi wasn't founded until 2012. So could you tell us a bit about what that sort of in-between time looked like, if you were pursuing other entrepreneurial pursuits or what you were up to?
Yeah, I needed to figure it out. It took me a little while. I had to get stuff out of my system. No, I think, you know, graduating, I wasn't ready. Like, I developed a little bit later than most, like, I think, in my mind and stuff. And I just needed to, so I worked for someone else. I worked for this real estate developer in the suburbs of Chicago. and did that for 3-4 years. Then I went on my own and started to do I bought some small apartment buildings and fixed them up and renovated them using the construction management skills I had learned from that job, and then sold those. And then 2008 happened, and actually at that time, some of the biggest learnings I've had were from the financial crisis of '08, where the banking system literally almost collapsed, and like there was a lot of everything was out of whack. And I went back to work with my dad at his company, APAC, and then also sort through a lot of investments and a lot of learnings of what basically not to do, right, in that time frame. But coming out of that, I saw the opportunity because I saw what went wrong in that cycle, and was able to use a lot of that, kind of. And so hopefully you guys don't have anything like that, coming out of because it was a very tough time to get, jobs, and the kind of things took like till 2011, 12 for things to unthaw after such a significant event. But, I went at my pace, and I think I started OppFi when I was, 28, 29. So it took me, 6, 7, 8 years to get going. But then I really, felt like I hit my stride in my 30s is really where I started to really feel like I was, hitting my confidence level went up at that point. So, yeah.
Awesome. Well, thank you for the questions. That was as close as we got to you to almost cry, huh? See, I promised you I wouldn't. I had a plant in the audience, though. Bingo is, please come up.
Tearing up over here.
Yes, right?
Well, and before, Paul, thank you. I know you have closing remarks. I just want to thank everyone for coming out. It really means a lot to me that you guys have the interest and initiative to come out and hear me speak. It's a big honor to be here, and with the Freeman family in attendance. Thank you for coming and supporting this partnership, and thank you for putting this together. I appreciate it.
Thank you, Todd. This was amazing. Thank you, Mike. Lots of lessons that we all learned. I think having a high-level mission and sticking to that, that's extremely important. Control your trajectory, how fast you go, not giving up equity if you don't need to, testing things, testing the waters before you make the move. But to me, the most important one is the attention to the customer satisfaction, and I think all of those amazing lessons. I'd like to take a moment to thank all the students for the great questions. Do we have great students or what? So let's... and thank Mike S. for being a great facilitator, moderator, interviewer.
I think you have another career. You got another career ahead of you.
It felt like a natural conversation.
Natural, yeah.
So I have here a plaque to honor the occasion, and I'd like to present it to Todd. Thank you, Todd.
Thank you. Wow.
And Todd and his family will be back in September when we have the official dedication of the Schwartz Family Business Experiential Learning Center. We're looking forward to that. So thank you very much for coming, and thank you once again.